Thank you for still being here with us. And thank you to my panelists that are here today to discuss African versus European startup. Is it really that different? So to talk about this topic, Ben. So Ben, Marrel, you're co-founder of Breega Capital, a French VC fund on early stage. Zach, George, you're a managing partner of Launch Africa Venture, a Pan-African VC fund. Hangwi, Muambadzi. Yeah, you're the venture partner for Commerz Ventures, a fintech-focused VC firm. And finally, Mareme Dieng, you are leading the strategy and expansion of 500 Global on the African continent. Right. Thank you again for being here today. So to start this panel, we're going to start by the beginning, which is a very simple question. Is it different to build a startup in Africa rather than in Europe? Who wants to start? Ladies first, of course. Mar. Oh, you don't have your mic. Come on. Thanks.
Hi, good morning, everyone. It's an absolute pleasure to be here with all of you. Jolly, I think it is different. I wouldn't say it is necessarily more difficult. One, I've never built a startup in either of these markets, but I can tell you how it is perhaps different in some ways. Speaking from a fintech perspective, if you maybe compare a neobank that has been set up in Europe versus a neobank that is being built in Africa, you might find that the final output and outcome looks similar. You know, it's still a bank, it's still got the basic pay, save, invest, whatever features come on the app. But the problems that it is solving for are fundamentally different. And this is a bit more of a generalistic view, but if you were to look at a Monzo or a Revolut or any other neobank in the European context, most of what it is solving for is maybe more rooted in user experience. Right? It is solving for maybe a more aesthetic or more pleasurable experience and convenience than if you look at a neobank example that is being built in an African market. It is solving for something a bit more basic in a primary sense. It is solving for the ability of people to have access to financial services for the very first time, the ability to be able to take out loans or access lending to do basic things from a lifestyle perspective, whether it's pay for education or food or services or whatever the case is. These are people that you'll find through this platform or through the invention of something like a neobank are accessing the financial ecosystem for the first time, entirely underserved or entirely overlooked by the general financial services ecosystem in each of these markets. The other thing is that when you start building a startup, whether it's in fintech or maybe anything else really, one of the differences I've also noticed is that the European context is, once again, you may be able to build something that, relatively speaking, you can basically build the front-end position of what you're trying to solve for and easily plug that into APIs or an infrastructure that already exists. When you're doing so in an African market, oftentimes you have to start from the beginning. Yes, you want to solve for problem A, but in reality, you now have to solve for problem B, C, Y, all the way down to Z before you can actually solve for the problem that you were trying to solve for before. So if you're trying to build a short-term lending product, for instance, you don't have the luxury of being able to plug into some sort of database that will give you an accurate credit scoring of all the individuals you're trying to get onto this platform. You actually have to go and build that data yourself. So you start by building or inserting a product in the market where you start tracking the sort of database or user experiences or even just behaviors that would allow you to then essentially build a credit algorithm of your own. So those are just some of the key differences that you might find when setting up a startup in a European versus an African context.
So can we apply what you said in fintechs to other kinds of startups?
I suspect in most spaces, yes, you can. Obviously, there are some industries where it might differ. You might find that the environment in an African market is much more ripe or much more constructive to building something in that specific space. But generally, I would think that sort of logic would apply in most spaces. I mean, I stand to be corrected. You guys might have other experiences that you might want to address.
Yeah, maybe Ben, do you think it's easier to build everything from scratch in Africa rather than, here?
I would be lying if I'd say it's easier. I think it's obviously more difficult, and to me, there are some similarities in terms of the level of ambition you need to have and the importance you need to pay to your values and team and structure, and all of this is very similar. But there are huge differences between building a startup in the US versus Europe. So I mean, there are obviously massive differences between doing it in Europe versus Africa. And to your point, I think, I mean, no massive opportunity comes without a price, right? And I think what I see a lot in Africa is that when in Europe, you're right, you can base yourself on existing infrastructure and on existing APIs and products and existing markets as well, because the markets have been educated by incumbents who are in place. Well, then, you're fighting against these incumbents, and your marginal value is smaller because you're just on top of an infrastructure that exists. So the price is much bigger in Africa when you do it right, because usually, there's not a lot of incumbents to fight for because no one's there. So that's also, I think, but obviously I'm biased, one of the reasons why I'm so excited about investing on the continent is that, yes, it's hard, it's probably harder, but if you make it work, if you make it right, then the opportunity is massive, because when you push, you can go as deep as you want, because a lot of the industries aren't structured properly yet, and therefore you can become one of the leaders way quicker than you do in Europe. Like, look at the number of neobanks that emerged in Europe who are still alive and still earn decent market share. Not much, right? Whereas if you do this in Africa, right, all of a sudden you can own that market share, and you own it for a long time. But as you said, yes, it's going to be a bit harder.
Go ahead first. I saw you wanted to say something.
Yeah, so I think one of the other points that I wanted to mention here is, yes, I mean, I've lived in Africa for the last 12 years. It is arguably harder from an infrastructure perspective to build, let's say, for example, a fintech going on the digital banking sort of start that Hangwi mentioned. But the one thing that Africa has in its favor from a tech founder perspective, especially in a market like fintech, is, you've got 54 countries in the continent, but there are only 3 major business languages, right? English, French, and Arabic, business languages. In Europe, you've got more than 30 countries, and every country has a different language, a different governance system, a different compliance rule. It is harder to scale a fintech from Germany into France, or a fintech from the Netherlands into Poland. Try doing it. I mean, N26, as incredible of a startup they are, they're still primarily in Germany and Austria, from what I understand. Similar thing with, Dieng is pretty much Benelux region. It's very hard to find a fintech that is truly pan-European, whereas in Africa, you can do that because of multiple reasons. Language is one. Number 2, most startups on the African continent tend to scale through insurance companies and through banks. So they use the rails of big financial institutions. And the reality is, if you look at the ownership structure of most African banks and insurers, they have very simple OpCo-HoldCo structures where a Standard Bank owns Stanbic, owns Stan Chartered, or there's a recent partnership between Allianz and the Sanlam Group, and through their subsidiaries, they own Saham in West Africa, Old Mutual through UAP in Kenya. So if you're a smart founder and you can partner with the right banking or telco or insurance plays, you can expand relatively quick well, quicker across the continent, and you have to do it in pretty much one language or maybe two languages. So I'd argue that it's probably easier to scale in Africa than it is in Europe if you play your cards right. And we've seen that in our fund as well.
Do you agree, Mareme?
I think I partially agree in the sense that I believe, like Zach just said, there is a certain level of existing commonalities on the continent that actually is not that easy to find in Europe because they have existing infrastructure that makes it very difficult for companies to actually go from one market to another in that way. But from a different angle, I would actually argue that Africa has a lot more particularities per region, per countries, and through there are 3 main business languages, but there is also hundreds of other local languages. And most Africans actually don't necessarily speak English, French, or Portuguese. So to that extent, I think the opportunity is there, but I think in practice, what we've seen is that companies who are truly trying to target more of the mass in terms of making sure that their solutions are addressing real needs are also having a hard time being able to reach out to that segment of population that doesn't necessarily have access to that level of infrastructure or even banking, because what we've seen is a lot of Africans are actually unbanked. So if you're thinking about the existing infrastructure and how it's being leveraged, I think that African companies are having a lot more difficulties because the continent is still 54 countries, lots of different languages, and still very, very, very different infrastructures.
I think you're right. I think from a B2C perspective, fully agree with you. From a B2B perspective, different. And sorry if what I meant if I said Portuguese, it's actually English, French, and Arabic. But yeah.
And Zach, do you think that the African founders have a different profile from the European ones?
I think profile-wise, I mean, it's important to segregate it from experience and age. I'm a big fan of giving or speaking about facts and not opinions. So if you look at the average age of most African tech founders in the last 7 to 8 years, it's between sort of early 30s to mid 40s, right? In Europe, you could argue that it's probably a good 7 to 8 years younger, and in the US, even younger. The last time I checked, in the US for 2021, the average age was between 23 and 31 in the US. That's really low, right? But it's also a function of the availability of capital and the risk tolerance, etc. What you tend to see in Africa, in the tech space, is a lot of execs that work at banks, a lot in telcos, a lot in insurance, will spend about a decade in those industries, become really or become sector experts or product experts, and then use those networks to then start startups along with, former colleagues or partners, etc. And that's a good thing. We, as a fund, value experience a lot more than just raw smarts. And I think you got to, especially when it's B2B, and I keep saying this all the time, B2B and B2B2C is what works. And to be able to scale successfully a B2B startup, you have to have relationships with key decision makers in these industries. And I think that's a key differentiating factor between the type of founders from an age perspective and experience perspective in between Africa and Europe.
Yeah, we're going to talk, of course, about financing, because of course, that in 2021 there would be like a really big rush from the American investors into Europe, but they didn't necessarily have had an office in Europe, in London or in Paris. Do you think you need to have an office in Africa to invest in startups? And maybe Ben, because you already invested in a few ones here in Africa.
Just putting my toes in the water, right? But it's just before the big swim. I think it really depends on what stage you invest in. Yeah, first of all, I think the later stage you go, the fewer opportunities. Therefore, you can probably somehow manage them from overseas in a way, although doing this, you miss the local understanding of the market. But let's give or take, when there's 100 companies to explore a year, you can potentially do that from your desk and then come over, in theory, right? The earlier stage you go, the less probable this can work. Even if you are a fantastic US brand, let's say, some people may take you as a pre-seed investor or a seed investor, but then they will realize that it's a check and it's a brand name, but you're not receiving what you would expect from an early stage investor, right? And early stage, it's a lot of money, but it's a lot of sweat as well. Like it's really trying to support and help the founders you finance. And we've been one of the very first ones in Europe to build a strong scaling team to help our portfolio companies and grow and recruit and organize. And you don't get this from someone who's far away. It's almost impossible. So I think this, given the state of development of the African ecosystem as well, which is a pyramid, like if you want to build that base early stage, you need people on the ground. You need people who know people, because it's a people business ultimately, right? And it's great to have these events all together and to travel, and you have one in Dakar and Cape Town and Cairo and all these big tech hubs in Africa. But ultimately, early stage investments happens locally, I think. And I know, Zach and the rest of the crew, just spending some time on the ground, like always in the plane, meeting people, make sure these connections are alive.
I very much agree with everything that Ben just said, because, for example, in our case, we've made now about 114 investments in the continent from the US, and what we're learning is that as an early stage investor, there is only so much that we can do by being so far away, to the extent that, especially on the continent, a lot of business relationships are driven by peer-to-peer connection. And so when you're an early stage investor and acting from so far, obviously you have the advantage of giving them a global platform. But in order to get them to that level where they can actually scale to a global platform, you need to help them with being able to kind of navigate the day-to-day. Also just navigate being able to leverage connections, being able to leverage your network. And we're learning more and more that it's difficult to do from all the way to San Francisco, not even from France or Paris, but all the way to San Francisco, which is 9 hours out in time zone. And we've seen that in other regions like LATAM and MENA, where we've implemented offices, we've seen that to work a lot more effectively in the way that our companies can progress. So for sure, I completely agree. I think US companies, I think a lot of them will still continue to do investments from the US, because for them it's still, unknown territory in the extent of they are still trying to figure out how they go about building a local presence. But I think for a lot of the early stage investors in the Bay Area and as well in New York, a lot of us are definitely looking into how could we be a lot more present on the ground, because it's difficult to do that from there.
And Hangwi, how do you do that? Because you work for a German VC fund.
I largely agree with everything that's been said. I mean, it's 2022, so an office is slightly overrated in the physical sense, right? But if you do not have actual sort of physical footprint in the markets that you're investing in, you're doing so to your own detriment, in essence. I mean, as you said, it's very much, doing business in Africa is very much relationship-based. And if you're not able to build those relationships, it's a risk you'd be basically willing to take. It's your capital, I guess. But it's very advisable to have some understanding of the context, the nuances, the cultural differences. I mean, I'll give an example. There was a fintech we were looking at, based in Nigeria, and I happen to be the only person who's had a lot of Africa exposure and experience working in various markets across the continent, right? And so one of the challenges when looking at the data, just from a data perspective without the context of where you're investing, is that you only get that one-dimensional view. And so the company that we were looking at had a particularly high and high is relative here. It had a particularly high default rate. And so there were, massive red flags and concern, and it's just like, well, we're never going to get the money back, or this, fintech's never going to get the money back that it's lending, and. And so one of the things that I think I mentioned in that conversation was that, well, you have to understand that Nigerians are a very different people to Germans, as an example. And so it's easy to want to make the benchmark from a German perspective, very rule-abiding and very structured. And if I've got like a debt, I will pay it off in the 7 days that it's due. But I've spent some time in Nigeria, and I could almost imagine this conversation playing out in a Nigerian context where someone hasn't paid back the monthly installment that they're meant to. And it's just like my sister, don't worry me all. I'll pay you when I pay you. They're going to pay eventually. They're just going to do it in their own time. So the concern that is being flagged in a very sort of arithmetic perspective doesn't actually exist if you take the sort of the broader qualitative perspective and understanding, and you won't have that if you haven't been there, if you haven't interacted with the market and engaged with the dynamics of it. But also we've all sat on the other end of phone calls where as soon as the call ends, a whole other discussion happens, unrelated or sort of adding a completely different lens to what was discussed. And again, if you're not in the room, you miss out on that.
And I guess you've noticed that there's a slowdown in fundraising lately. Do you think it's an opportunity for African startups or no, Zach?
Yeah, I mean, we've said this before. I mean, last year, 2021 had, by various accounts, between $600 and $700 billion of VC globally, right? And Africa, even at a stretch, was about 6 billion, right? So, depending on who you want to agree with, it's less than 1%, right? So, if anything, with markets in Europe sort of arguably going through a bit of a stagflation moment right now, there's a reallocation of resources into emerging markets. And you could argue that a lot of the problems around increasing interest rates, an ongoing war in Europe, and instability in Southeast Asia has not really filtered down to the global south, if I can use that term, sort of Latin America, Southeast Asia, and sub-Saharan Africa. So I think you're going to see a repurposing of assets. We're seeing that. We haven't seen the African ecosystem really affected that significantly. We're still, about 20% of the world's population is African. About close to 8% of the GDP is Africa, but we account for less than 1% of the world's venture capital. And Christoph makes this point often when he talks about the ecosystem. So the only way, I'm not a forever optimist, but I'm a realist. And the reality is, with a population growing quicker, we've got 1.4 billion people in Africa growing quicker than any other region on the planet, and we're moving from a producer to a consumer-driven economy. And three important things are happening in Africa. The cost of data is going down significantly. The number of people that are online is going up exponentially, and the number of people that have smartphones is more than the number of people on the continent, and it's growing very quick. So with a consumer-driven economy, the opportunity for venture will only go up, and I don't see this stopping at any point. I see it, if anything, it's going to be counter-cyclical and go up.
Yes, and I think, go for it.
Go, please.
So, no, I was about to say and comment on this, I agree with you, and it's even more exponential because, yes, there is, this growth by design from the African population, which is going to double in the next 30, 40 years. And it's exponential because if you want to sort out the issues attached to this growth, it cannot be done without tech. It's impossible. Like, how can you put, 1 billion kids to school in the next 20 years without tech?
Yeah.
This is not going to happen.
Yeah.
So that's why it's so exciting, even if you're very rational and without trying not to be too much of an opportunistic, natural growth plus issues that cannot be solved without tech is just, you know, paradise for people like us.
I want to hear Marem's thoughts, yeah.
So sorry, we just need to open up for questions.
No, I want to hear Marem's thoughts, please. I want
Just so
Yes,
she
we will.
finishes and then.
I was going to add that I feel very similarly to Zach from the perspective, not from fact, but just being very optimistic about the continent. I think what we're seeing today is there are issues with the global market, but what I like to remember is, like you said in the beginning, African startups, unfortunately or fortunately, still have a lot of real problems to address on the continent. So as far as their total addressable market go, they still have an incredibly growing opportunity every single day because there are still real issues on the continent that can only be targeted through technology. And just for that matter, facts and numbers aside, there is this optimism to believe that there will be continued investment opportunity. And as Zach has seen, we actually haven't seen this to affect early stage investment in particular that much on the continent. Early stage investors who are African, US-based or Europeans are continuing to invest at the same rate as they did at the beginning of this year. So I think that entrepreneurs, African entrepreneurs, should be aware of these global dynamics, but I would definitely say that they should not panic. And I think that there was, at some point, some messaging going around trying to get people to panic, and I would strongly advise against that because these are not what we're seeing play out.
Yeah, thank you. Now it's time for a Q&A session, so please raise your hands.
First, I want to say, guys, amazing panel. I really enjoyed that. And then a question perhaps towards Zach. I'm quite keen to hear if you have any tactical advice for a startup that's trying to establish ties, at least from a B2B perspective, with the banks and the telcos on the continent. I didn't introduce myself. I'm Lerato from Trudenty, and we're a decentralized identity startup.
Yeah, I get that a lot. So I think you can either approach them directly, which is not recommended. So there are some really incredible accelerators on the continent, and most accelerators now are funded by corporate partnerships. So, you know, I'm very happy to, not to promote, but to call out good accelerators, right? Founders Factory works very close with Standard Bank and Netcare. You know, 500 Startups, of course, has tremendous corporate partnerships. Mareme's in the house. Startup Bootcamp that I used to co-found, you know, works very closely with Telecel. So just do a bit of digging. The accelerators, and it's not just the global ones. A lot of regional accelerators. If you happen to be in the Northern African region, Flat Six Labs has incredible partnerships. My friend Gregor, if he's still here from Orange, they work very closely with a lot of accelerators in the northwest French-speaking part of Africa. So, and accelerators have KPIs with their corporate sponsors. So if you approach them, and again, I'm happy to share contact details of all the accelerators that we know of. That is the quickest way to start doing POCs. Would highly recommend that.
Hi everyone, Antoine from FCB. Just a question for the panel. Your preference, a startup that is in Africa scaling across different African countries, or a startup that is in Africa in one country trying to scale up in Europe?
For me, that's an obvious answer. An African company definitely scaling through Africa, because what we're seeing and what we've seen with some of our portfolio companies is sometimes, but depending on the solution, of course, some of their solutions might be more adapted to more mature markets if they want to scale out differently. But even in those times, usually what we would recommend is for them to look at LATAM or Southeast Asia, because the cost of actually expanding into Europe ends up being, for them, one, a higher risk, and two, a higher cost structure. Whereas when we're looking at companies who are trying to expand from, let's say, Nigeria to Kenya or Egypt or South Africa, like I mentioned earlier in the conversation, some infrastructural challenges make it very difficult. But the opportunity that lay once that they understand how to actually replicate that expansion model from one big market to another, or one big market to a smaller African one, tends to be a lot more cost rewarding on the long term. So historically, for example, we've seen startups in different countries who are ideally looking at going to the US or going to Europe. But for us, from an early stage perspective, we tend to not recommend that. And if their solution is more adapted to more mature markets, we'll actually ask them to look into LATAM or Southeast Asia or MENA.
Yeah, I think back to my initial point, I mean, there are markets that are so different, you know, by design, that it's very rare that you can build a playbook that works in Europe, where a lot of European founders fuck it up, by the way, from Africa. And it's no disrespect from African founders, just like it's super hard, even when you're local. Like even when you're local, born and raised in Europe, you know, did an exchange at university in Germany, you fuck it up. So I think it's not a great idea. Like if you were to choose one, developed markets, I would go US or China, like at least a big one where you don't have that sort of, you know, hop on, hop off kind of mentality. Once you've built your playbook in Africa, going to different geos, different cultures, different languages, and the best opportunity for you is Europe, why not? But it's kind of a long, you know, shot. I reckon that, you know, given the fact that you probably have been building your own infrastructure, your own solutions for, you know, emerging markets, going, you know, sideways versus that, you know, north-south is probably a better idea. So first of all, Africa, and then, you know, you have massive countries in Indonesia, Pakistan, Latin America, you name it, right? It's big. So I would probably recommend that route. Obviously, every company is different. So that's a very generalistic view, but I think that makes more sense 90% of the time.
Maybe just to add to that, I think it also very much depends on the problem that you're solving for. You get people that are in love with their problem and people that are in love with their solution. And if you are focused and, say, solving for a specific kind of problem, you might find that that problem is as relevant in an African market as it is in a European market, and also hasn't been solved. I mean, I recently spoke to a startup that was more in the hardware space, and they were building tech around visual aid for those with challenges or disabilities visually. And the market where they started in, even though it was a very relevant, and still is a very relevant problem, you'd find that the technology that they developed, the price point at which they were trying to sell it wasn't affordable in those markets, and only really served a very small niche right at the top of that. But the problem is still very relevant in a lot of markets. And they've recently just scaled and expanded into European markets, and they're actually doing quite well. For something that you would have expected to have been solved already in a European context, but the technology that they're coming in with hasn't been developed, and is in fact, because they're coming from a African development, they've developed it at a much lower cost than what is being offered as a solution in European markets. So really, it depends more on, for me, the problem that you are solving for and where it's most relevant.
Just one final question here.
Excuse me, my name is Christian. I'm from France. I'm the CEO of Mobile Ecosystems. So my question is about investment. We love to talk about unicorns, you know, that raise a lot of money. What about the rest? What about the thousands of those companies that are building things? And how can they be supported in this time period in order to accelerate? Because the reality is how we can build growth for the next billion in Africa, not for the happy few. So
as we're in Paris, let me use the French word. You probably have one of the nicest brochette of early stage investors here in the African continent. So I think, you know, we're all pushing hard to make this work. So yes, there's a big network. These events are all done for this. I think, you know, it was harder it's not easy yet, but it's getting easier, and there is money from people like us around the table to invest in early stage companies.
In fact, it's lunchtime, so let's go eat the brochette.
Wow.
Thank you, guys.
Right.
My pleasure.
Thank you.
Can continue the conversation over lunch, of course. Our guests are here all day.